and welcome to another exciting episode of Finance Footnotes. I'm your host, Brent Stransky, joined by my colleague and co-host and friend, Zach Miner. Today's June 25th, and it's been a while, Zach, since we've had a podcast. And when clients and friends are asking you when your next podcast is, I think it's time to get out there and do another one. And a lot's happened. There's been so much to happen in the last 4 weeks. The news cycle seems to have accelerated significantly since we spoke to you last year. So I want to spend several slides talking about where we are. Then I'm going to talk a little bit about the other war going on. No, not the hot war that's unfolding in the Middle East. I'm talking about the federal bank head Jerome Powell and the president of the United States. And then I want to end with a couple of optimistic notes. The teaser is, if we have a positive May and a positive June, what happens for the rest of the year? So that being said, let's get started right away. As usual, I have a clipping here of the Wall Street Journal from this morning, just talking about where the markets are. And I highlighted a couple of points because if you can believe it, Zach, since the tariff tumult in early April, markets have regained all that and then some. So markets are, as of this morning, within 1% of all-time highs that were set back in February. As of yesterday afternoon at the close of markets, the S&P 500 was up 4% for the year. So I think that's been a really robust rally here. NASDAQ on a similar footing as well as the Dow. So that's just a quick snapshot where the markets are. I want to spend a few slides talking about where the other primary markets are. There's been so much going on in the Middle East, so much going on with the tariff war. We never get a moment's rest. But I want to share with you a couple of important slides. The first I have here is the CBOE Volatility Index, and this is sometimes called the fear gauge, and it's a metric of how much protection people are buying the portfolios, and ergo, how frightened are people. And so, Zach, correct me if I'm wrong. This is low. If you can imagine that, last week the United States bombed Iran, and the fear gauge is at 17. It's very low. It hardly peaked above 20. It seems astonishing. I think if you asked people 10 or 20 years ago what would be the outcast, they would have thought the stock market would be down 20 or 30%, and that the VIX would have spiked 50%. What do you think?
Yeah, I have a slide later that, market sometimes zigs when you think it's going to zag, and you could put this chart right alongside the two that I have there. It's typically anything under 20 kind of signals very relatively low volatility. Anything once you get to below like 16 and 15, you start to think about complacency. But yeah, 17 is calm waters, and with all of the news that we've had over the last couple of weeks, it's a pretty amazing reading for this, for sure.
And I'll talk a little bit later about why I think that is the case, but to kind of build on this idea. So the VIX has been stable. Oil, my God, it's below $65 a barrel. As of a month ago, oil was about $60 a barrel. That was at or near 4-year lows. For several reasons. And then it spiked, of course, with the bombing and the possible closure of the shipping lanes in that part of the world. Oil spiked above $75 a barrel, but has since dropped back down to 64. So it's hard to believe. Going in line with the VIX index, oil markets have been down. And the other chart I want to share, the 10-year Treasury note. My God, it's actually been slipping. We've heard so much about the debt, so much about the bills going through, the budget bills going through the houses of Congress, and yet the 10-year Treasury is sliding, which is interesting to me. I don't think that necessarily suggests that there's a lot of fear in the marketplace, although that does insinuate there's buying. They're not, investors aren't demanding higher interest rates. So, wow, things are relatively calm despite everything going on.
Fairly stable with the yields within a range. For most of the year, kind of at the beginning, we got a little spike in January and February, but really for the last 4 months, yields have been pretty range bound. 4.2 to 4.4 ish, kind of bouncing around in there. And I think it's just a combination of things. A little bit slowing down in the economy, but counterweighted by potentially higher deficits, some potential tariff inflation counteracted by some flight to safety with the geopolitical issues. So there's pushes and pull on kind of both sides of the yields, and it kind of just keeping things stable.
I think income markets, debt markets are particularly difficult it's a particularly sticky wicket, you could say, Zach. Tough to predict what's going to happen there. And sticky wicket. It's what British people say. What the Brits say. Sometimes, maybe the British people don't say that. I made it up. But anyway, in my version of the Matrix, people say that. So just take a big step back with everything going on. And listen, this all started, with the election in April with the tariff, crisis, war, whatever you want to call it, and then extended through all the tension going on in the Middle East. Markets are climbing to all-time highs. The VIX at or near lows. Oil not reacting, and the 10-year Treasury ultra stable. Why is this the case? Well, there are any number of reasons, but it leads to the argument that there is stability in the U.S. equity market. And the one point that I want to make here before I move on is that the labor market remains strong but cooling. 4.2% unemployment rate. We'll get a new read on this data coming out in just a week. But for the last 3 months, at least, the markets, they're predicting entities that are out there putting their best guess forward in the marketplace have all thought that jobs numbers would come in much lower than they did for 3 months in a row. Now, the trend is certainly cooling, but there have been jobs, and we'll have to see what happens here for the June job numbers released on the first Friday of the next month. Is that the case? Because I don't know. What do you think, Zach? Because the 4th of July is coming up. Are they going to release it this Friday?
That's a good question. I'm
I guess
not entirely
I
sure.
guess not.
Yeah.
I guess not on the holiday, but it'll be coming soon, my friends. I promise you. Probably that Thursday.
Yeah, and this is really interesting. I think the labor market is going to be one of those things for the next however many years that it may lose some of the predictive power with I think with AI. I think with what artificial intelligence is gonna create some disturbances in the labor market that should be offset by productivity gains by the companies which are doing it. And so you might see an increase in unemployment, but not necessarily a decrease in GDP and productivity and S&P 500 earnings. The things that you say, okay, unemployment's starting to rise. It generally means like, hey, the economy's slowing, which should filter to corporate earnings. And I think that link may break a little bit because you're already starting to see headline after headline after headline. This company reducing workforce by X% because of artificial intelligence tools, and it's already happening. It's going to continue to happen, and I think accelerate. So
I like that idea that it's these ideas these. So I'm showing you right now the headline numbers, right? Unemployment rate, and then jobs created in the economy. Those are the two biggest numbers that most people care about. But there are some cooling, to Zach's point, underneath this, and there's something called the the job openings rate, right? The JOLTS report has come down significantly. There's meaningfully fewer jobs open than there were per person seeking a job 12 months ago, which I think was distorted by the COVID data. But that's come back in, as well as the labor force participation rate has eked down a little bit. So those are things to watch. That's what the Federal Reserve is doing. And that, my friends, is the springboard into the next discussion. What is everyone talking about? It's the war of words between Jerome Powell and President Trump. So just this morning, I pulled this off the AP in my local San Diego Tribune. Powell says Fed is going to wait before the cuts. Zach, do you ever watch any of the, on C-SPAN, do you ever watch the Federal Reserve chair,
sometimes
adding back questions from the
press
Senate
conferences and
would you agree that the questions coming from these people leading our country are, have like a basic, the most rudimentary economic understanding? Like,
I don't watch too much of it. And this goes for really any testimony before Congress or, confirmation hearings. I mean, it's 90% political grandstanding. It's 90% of the time. It's the senators trying, or the Congress people trying to, they're making a point and they're not asking a question. They're making a statement in the form of a question.
They want to get that soundbite.
So very, very little do you actually get. And especially from Jay Powell. I mean, he's just very good at this. He's been doing it a long time.
Yeah.
He is never going to tip his hand. I mean, he's going to stick to his script. You're not going to get anything particularly explosive from him, in these settings.
And so, the commentary it was a very mature conversation between both parties in the Congress that were questioning him and the chair. So, but he did say, and I quote, "For the time being, we are well positioned to wait and learn more about what is likely course of the economy." So he's staying the course, right? And so that's what he said. That was yesterday. And President Trump came out and he said, and I quote, "I hope Congress really works over this very dumb, hard-headed person," speaking about Chair Powell. "We will be paying for his incompetence for many years to come." So, okay, does the president have a point? Well, I'm going to turn to that in a moment, but before I do, I want to talk a little bit about where we've come from. And of course, the Federal Reserve, it's so important because it affects every aspect of your lives: your mortgage rates, your home rates, insurance, the rates you're getting in your CDs and savings and bonds, how much companies can take loans out to grow their business. So typically, lower rates are more stimulative in the economy. And you can see that because of the COVID bump, inflation did peak significantly, but has fallen steeply. Again, like the job number, it's been better than expected for the last several months. The Federal Reserve chair, is afraid of that the tariffs could increase inflation. So that's what he's waiting to see. He thinks we have time. But as of last month, 12-month CPI headline 2.4% and up only 0.1% in the month of May, which, as you know, if you're doing your math, times 12, 1.2% annualized. So it seems to be dipping. I thought this was interesting. And then, Zach, I turned to our chart we've looked at in the past, which is Truflation, which I like. Truflation. It's real time. I think 60 or 80,000 real-time data points. And as a byline, you probably saw, I know you saw, Zach, but you folks at home may have seen that the Federal Reserve came under some scrutiny because they've had to lay off a bunch of people or didn't do the more rigorous testing of prices in the economy as they usually do. So there's a lot more guesswork in these last couple of months' figures. That being the case, maybe Truflation is more important now than ever because it uses real-time data. But yeah, it has creeped up significantly from a low of a month ago of 1.2 now to 2.2. Zach, did you see this?
Yeah, and I think this just, reflects the many more data points I think it gathers, and in a real-time basis. So, my read on it is that, and I've been in this camp, most of the year. I think in the beginning of the year, we kind of talked about how many rate cuts they were going to get. And I'm still kind of in alignment with Jay Powell that probably going to be two or one.
That's good company to be in, my friend.
One or two. I don't think there's any indication in the economy or the markets that would suggest rushing to cut rates. I think that would actually be viewed as, potentially negative news that they had to, pull forward their expectations, because they've been saying this for a long time, right? It's been well telegraphed that a couple cuts at the back half of the year is what they expect, and if they just turned around and did one at like the last meeting, I think that would be viewed as saying, well, wait a second, like what's changed so much to make that worthwhile? So I think that's what we're gonna get, and I don't think there's any reason for them to rush.
Well, who knows? And it's as possible that President Trump's, strong words are actually making the Fed chair more resolved in his approach, right? Because he doesn't want to look to be caving into the president's demands. But I just wanted to address the point in the room. When I've read a lot of smart commentary who said, well, maybe the president does have a point, right? And so just have a couple thoughts here. I'm not, I think his war of words is wrong and ill-suited for the position of power that he's in. But be that as it may, the Fed has cut rates 3 times in the past 12 months, while the ECB has cut, the European Central Bank has cut 8 times. Now, different economy, different rules, but very correlated. So, the president sees that, and that's an interesting point. The Federal Reserve is supposed to be apolitical, but they did make one, or maybe it was a 2, Zach, half-point cuts last summer before the election. So from the president's perspective, and a lot of commentators, that was a very political move to try to juice the economy in a way that could possibly, from the President Trump's perspective, play good for Harris or Biden. So, that was his point. He thinks that Powell has been very, has been accommodative to the Democrats and less so to him. To President's point, inflation is cooling. And then last week on Friday and Tuesday of last week, I guess, 2 of the 18 Federal Reserve governors said that they want lower rates in the coming meeting in July. So we'll have to wait. That's the end of July. We'll have more information to see then. I heard an interesting commentary, Zach, from one of my favorite commentators, and he said about Jay Powell. He goes, I don't know Jay Powell, but he looks like the kind of guy that would eat the cashews out of the mixed nut bowl as it passed by. And I was like, that could be it, man. All right. So
I like that.
2 more thoughts for you folks at home that I want to share before I hand it off to Zach. And I think this is okay, with all this information, what does it matter? Who knows? What do we do going forward? So the first thing I want to point out, but just poly markets, this is, you can bet on anything. Poly market graph as of this morning, showing that there's about a 20% expectation for a rate cut in July. Still about 80% of people don't expect a rate cut going forward. These are people putting their money where their mouth is. So we'll have to wait and see if that has any predictive value. Now moving on to the 2 points I wanted to make for you. People are still pessimistic. And I thought this is strange because you've seen a lot of money come into the marketplace through May and June. But this is the AAII, American Association of Individual Investors, pulled off this morning from a survey last week. And it's showing you, 33% are bullish. This is at or about what it's been for the last month. Or is it 2 months to the last month? And it's interesting because it's meaningfully below the historical average, which is 37, or in the last 1 year high, which was 52% as of last summer. So, individual investors, at least according to this unscientific survey, you still have some degree of underweight. They're less optimistic, more pessimistic than they might be. And I thought that was interesting based on how well the market's doing. And then this other chart from our friend Ryan Dietrich
Ryan.
at Carson & Wealth. Good old Ryan. We've got 2 notes from him here today. This is the first. I thought this is really interesting. Zach, did you see this? In terms of professional money managers, where are they weighting? So the screen here, folks, if you're driving around, there's maybe a dozen or so different investments, emerging markets, bonds, etc., cash. And where are professional managers either overweight, putting more money there, or underweight, putting less money? And so of these maybe 12 to maybe 14 different asset classes, the most underweight historically is U.S. stocks. So professional managers significantly underweight. I think this is a good contrarian indicator, Zach, that could suggest that, if things are overweight, that money has already been put to work. It could indicate that things continue to press on higher in the next 6 and 12 months as, this reverts to the mean. And that's the proposition ahead for folks. Any thoughts there before we move on to my power slide?
Yeah, and it's it seems like international has kind of just started to outperform, but it's actually outperformed for the last 3 years over the US. So this isn't necessarily a new trend. Now, those trends do tend to persist for long periods of time. But I think you're right that the allocation shifts have kind of all taken place, and now you're at that point where to get back to like a neutral weight, you'd be buying U.S. equities.
So, man, this is crazy. I don't know if you saw. I saw this kind of in passing. I think it kind of speaks to the same idea that there might be a lot of cash on the sidelines that could possibly come back into U.S. stocks, as crazy as that sounds. And I'm looking here at the Federal Reserve Bank of St. Louis talking about their personal savings rate. Zach, did you see this? That since December, during COVID, people were cashed up, people were saving. Since December, people, when it troughed, bottomed out at about 3.5%. Now it's picked up to over 5% again. Did you see that? Savings rate has increased significantly. People are saving more money, putting more cash on the sideline. That big pool of $7 trillion on the sidelines in money market and CDs and cash is getting bigger, not getting smaller, which is just wild to me. So I think that plays into the point that we just made, the little segue there. But coming to what I call the power slide, this is the one optimistic thing I want to share with you before we move on and hand it off to Zach. But this is again from our friends Carson at Carson Wealth. But May was a great month for the stock. Of course, April was terrible. May was great. And June looks like it's going to shape up to be another great month unless something happens in the next couple of days. So this isn't that common. Actually, there's been 14 previous times since 1988 that May and June were positive. So it's not a very frequent occurrence that these months are ultra positive. But I think this is very interesting. And if you're looking at the chart here, you can kind of see on the right-hand side, final 6 months, you can see are higher every time except for one, with so 94% of the time of those occurrences with an average or a mean of 8.7% positive return in the final 6 months, and then 87% are positive in the next 12 months with 15.5% mean. Suffice to say that I think that there could be momentum in the market. I think there's reason to stay the course in U.S. equities. I was really surprised to see that chart of underweight of professional money managers to U.S. stocks. I think that could play well for investors in the next year or two. So, please keep that in mind. Typically, it makes sense to stay the course. And with that, Zach, I humbly hand over the slides to you, my friend.
Might have to change the saying to buy in May and maybe just stay. I don't know.
I like it. Let's coin it. Let's get a trademark, man. Good
buy
work.
in May and maybe just stay. Oh, there we go.
Yeah,
like that.
Stop trying to sell in May. Oh man. All right. Politics. Here we go.
I wanted to a quick piece of news. This just happened last night. In the New York City Democratic mayor's primary, right? So it's a Democratic city. The Republican is most likely not going to win. And this gentleman, Zohran Mamdani, that I do not know much about, but I do know that he's a Democratic socialist, particularly progressive in terms of New York City politics. So I think this is just a quick read. It's a quick read from a Democratic stronghold, just about kind of what the electorate's looking like. It seems like the progressive push, at least in New York City, has really kind of taken hold. And Andrew Cuomo was the other candidate that was on the ticket there that was projected to potentially win, and he's he's got idiosyncratic issues, right? I mean, sexual assault
He's uniquely
scandals, kind of a
uniquely
disgraced
disliked.
governor, uniquely disliked. So was it more because of him? Maybe. But I did just want to flag this. I think this is really interesting just for going into the midterms next year. What does at least the left-handed side of the spectrum look
Yeah,
like? And
they're certainly energized. In just a little color here,
yeah,
if he does in fact become mayor of New York City, it will be by far the most left mayor in New York City. Well, yeah, in New
by
York City.
leagues, by
Yeah,
leagues, yeah,
significantly.
by
So
quite a lot.
yeah,
So and look, I think you can just kind of look at that and say, okay, well, is the Democratic base, swinging back towards the center based off of last year's results, or are they coalescing and swinging farther to the left? At least this early little picture, this early look at it would indicate that they are swinging
it could
towards the
also be
progressive
kind
left
of
side.
myopic where there wasn't
Could
a
be.
good option for
For
folks. So
sure. No,
we'll have to
100%.
wait and see.
100%. But thought it was interesting.
Very
This
interesting.
is that chart I was talking about before, the zig when you think it is going to zag. And if you were saying that Israel's at war on multiple fronts, there is a hot kinetic war in Iran. The United States is bombing the country. Israel's bombing the country. Missiles are flying. I don't think you would probably expect the Israeli Tel Aviv 125 stock market to be at all-time highs and up as one of the best performing stock markets in the world year to date. And I also don't think you would expect oil to be trading down, 15% in a period of a couple days. So this is just, an add-on to what we were talking about before. That a
It's
lot of
hard to make
times
predictions,
it's very hard to
especially
make
about the future.
predictions. Yeah. And I think oil you can kind of look at and see. You can say, okay, well, the ceasefire came into effect. The Strait of Hormuz is still flowing. Like I can kind of get that. It's hard to see necessarily the Tel Aviv stock market being at all-time highs. With the country. But the Tel Aviv stock market headquarters was literally damaged by a missile like 2 weeks ago. So
Yeah.
um, so hard to make predictions about these types of geopolitical
I
things.
think it could be, and we'll hear more about this, but the peace dividend, right? I mean, Israel has been living under the threat of nuclear
Yeah.
destruction from Iran for as long as I've been paying attention, and that's certainly lessened. And I guess that peace dividend
Yeah.
would have its biggest sway there, right?
Yeah, and I think you're also seeing that in the U.S. and global markets generally, that it
Mhm.
seems like the Iran is significantly weakened. Their response to our attacks was essentially a non-response, right? I mean,
Mhm.
they
Mhm.
sent some missiles over to Qatar that is it Qatar or Qatar? I know that there's
Qatar.
two Qatar that they essentially warned both us and them about. Like there was no intent to actually hit anything there. And
Yeah.
I think that the world and investors and market participants are kind of just viewing this as like perhaps moving into a new phase where maybe we can bring them back into the kind of community of nations and basically say, all right, look, you guys are kind of down and out here, and maybe that can move forward in a positive direction.
Yeah.
So
In the
we're
Middle
gonna
East,
bounce.
Iran in
Yeah,
particular has been a real sticky wicket for at least 40 years. I'll
sticky
stop
wicket
saying
again.
sticky wicket. I just wanted to say it one more time.
So we're going to just bounce around a little bit as I am wont to do sometimes. Next one is just another play on what you showed about the optimistic take and just the strong, incredibly strong momentum that we saw in the NASDAQ 100 after it rallies from down 20% to basically flat, down 2%.
Hmm.
Below a 1-year high within a 50 trading day period. So 18% within 50 trading days. What does that mean a year out? And it is gangbusters, right? I mean,
Wow.
42% average returns, 100% of the time, never up less than 13%. This only happened 6 times. So it's not a common occurrence, even for the highly volatile NASDAQ, right? This isn't the S&P.
Mm.
This is the more volatile growth tech stocks. And to see that breadth and that surge of buying momentum has typically been a very positive sign, 38, 43, 91% 12 months out. So
Wow.
hard to, I
Yeah.
think, step in front of that train,
Yeah.
with the breadth and the surge of buying power that we've seen.
Yeah. Yeah. It's another great indicator of momentum coupled
Yeah,
with, yeah, I mean, there's a lot going on right now, but there's a lot of positive things. I think, yeah,
definitely.
there's a lot of reasons to stay the course and or possibly think about putting money to work.
Yeah. And so this next one, we hear a lot of kind of um, like bifurcated economy news. There's a lot of folks struggling. We saw, student loan delinquencies are at their all-time highs, right? I mean, some layoff announcements, some softening among the lower income classes, and you're like, okay, but that's not getting through to like the S&P earnings and retail numbers, and like, so why is that? And I thought this was really interesting in that the changing nature of kind of who's making up consumer spending,
Wow.
and the top 10% of the income bracket is 50% of consumer spending. So the top 10% are half the ball game with consumer spending. The next 30% are another 30%. So you're really looking at the top third of the income brackets, which are doing well, right? I mean, those aren't the folks necessarily that are having, the financial difficulties in this economy, and we really are starting to see. And we looked at several slides in the past that illustrate this, that there is a hollowing out of the middle class, but it's really more people moving up in income than moving down. You are really
Mm.
seeing not so many people in the middle, but folks are moving up the income spectrum. And so you see those retail sales numbers, and it's like, well, how is this kind of being sustained? And it's really being sustained by the higher income brackets, which are not really experiencing some of the other issues that we're seeing in the economy, are not as affected by inflation, right? And things like that. So I thought this was interesting, and this is very different. You can go back, if you look back into the 1990s, where it was about a third for each of those. Now it's went from 65% combined to 80% combined for that top third.
Yeah.
So I thought that
Yeah.
was really interesting.
Interesting.
Um, One little frothy indicator that I saw, one thing you can kind of look at is just the kind of aggregate allocation amongst household mutual fund, pension funds. So this is like global investors. What's their equity allocation? It's at all-time highs, above 50%. So it's just kind of an indication that portfolios in general are positioned a little bit aggressively, across the board. I think a lot of that is just by lack of rebalancing. I think, if you're not diligent with rebalancing, you might start with a 60/40 allocation. But if you go back from like 2022 to today and you didn't do anything to that, you would most certainly be, more aggressive than 60/40. So I think that
Yeah.
some of that, is there. But one thing to just flag, it's kind of you know, you can put that into the bucket of valuations where market cap to GDP is at all-time highs. We're kind of back to 23 forward price to earnings on the S&P now again. We kind of normalized it for a few months there, but we're kind of back to the top end of the range. I don't think things are cheap necessarily, but that doesn't mean there's not value. Continuing to
Yeah.
bounce around. It's a fight
Wow.
it's we're just adding to the pile, 7.5 trillion now, in money market
I
mutual
wonder what the
funds.
average the average deposit rate is. It's not 5%. It's and there's a lot of
No,
money
it's close.
at 0%. So it's probably, I don't know, 2.5 or 3%, but 2.5 or 3% of
So
$7 trillion dollars.
this is just money market funds. There's more if you add in
Mm.
checking accounts. This is just money market funds.
Whoa.
Um, yeah, 7.5 trillion just in money market funds. I think it's closer to 9 trillion if you add in, just idle cash elsewhere.
And for you folks, kind of driving around or not watching the charts here, we're looking from around 2010 to about 2018. It looks like about $3 trillion was a very steady figure over that period of time.
Yep.
And you can see that cash just skyrocketed, hockey stick up, man. People have so much cash on the sidelines right now. What does this mean? I think, if I can interject, my friend, when you have instances such as early April, when the market, crashed 20% because of the tariff uncertainty, I think it is a kind of a de facto put, right? Where individual investors come in and buy that bottom. We saw that in April when professional money managers were inactive, but individuals were buying.
Retail drove that. Yeah, that was a retail driven buying spree.
People
for sure.
have better cash positions on average than ever before, and this is, I think, true mostly across the spectrum. And they have a cash cushion, so they're not forced to sell, and they have the opportunity to buy in a way they never have before. So we'll have to see what that means for markets going forward, but I think it could be a put, if you will, a safety net.
Yeah, and look, you can look at this different ways. I mean, some folks will point to the fact that if you buy into the market, it means somebody has to sell, right? And that means more cash is generated. It's a net neutral, which some with ETFs, creation units and all these different things that can change that. But there is cash available for purchasing things, whether it be stocks, goods, homes. I think that we're I think on the verge of if rates do start to trend down, a home buying spree again. I think that's been consolidating, and it's kind of a bit more of a buyer's market right now. But I think that will change if rates tick down. But I mean, this pile just keeps growing.
Yeah, man.
And the last thing I'll leave you with is just something positive in general.
Yeah, I like positive
news. Not necessarily market related. But I think that this is going to continue to plummet. One of the things I'm most excited about with artificial intelligence is going to be the impact on the medical sciences, on treatments, on pharmaceuticals, on just screening, on everything that goes into making this death rate from cancer chart decrease. And we've made great progress. It was essentially flat for half a century from 1950 to 2000. And we've seen this trend down every single year since then, going from 140 deaths per 100,000 down to just under 100. So, significant decreases. And I think this is going to accelerate to the downside over the next 20 or 30 years. There's some really exciting things with gene therapy and additional immunotherapy drugs that are coming out that I think are going to be really exciting for this kind of stuff.
I love ending on a positive note. This, of course, has seismic repercussions across an economy that has fewer workers per retiree.
Aging, a lot of stuff. Social Security, there's a lot of. We could do a whole podcast on that, but for sure.
Yeah. All right, my friends. Well, I think that was a great reintroduction here. We'll get back to you in the next couple of weeks. But, in conclusion, just a reminder that things have been ultra volatile. If you looked at the news feed, you would not expect to have the data points that we shared in the beginning of the podcast, with the market being near all-time highs and volatility and pessimism at lows. So probably makes sense to stay the course. As always, if you have any questions or concerns, please let us know, and we'll see you next time on Finance Footnotes. Thank you.